The most dangerous year for your 401k is not always the year when the market crashes. That is the part most people miss. A crash is obvious. A crash is loud. It shows up everywhere, and eventually in your stomach when you open your account and see years of savings fall in a few brutal weeks. But the really dangerous year is quieter than that. It is the year when the rules change, the assumptions change, the tax math changes, the market structure changes, and most people keep doing the exact same thing because their 401k is on autopilot. That is why 2026 could be the most dangerous year for your 401k. Not because everyone is guaranteed to lose money. Not because you should panic. Not because anyone can predict the next crash. The danger is much more practical. In 2026, millions of Americans are walking into the same retirement machine they used in 2016, but the machine itself is not the same anymore. The contribution limits are different. The catch-up rules are different. Higher earners face a major Roth catch-up change. The market is more concentrated. Target date funds control more behavior. Household budgets are tighter. And millions of people are close enough to retirement that one bad sequence of decisions can outweigh years of good intentions. A 401k usually does not destroy wealth in one dramatic moment. It destroys wealth through invisible defaults, a default contribution rate that is too low, a default fund that is too aggressive, a default tax choice that creates a future problem, a default fee that quietly drains money, a default belief that says, "I'm invested, so I'm fine." That sentence is where the danger begins, because in 2026, being invested is not enough. You need to know what risk you own, what tax bill you are building, what account you are trapped inside, and what your future self might do when the screen turns red. Imagine two people, both 55 years old. One is named David. He has $430,000 in his 401k, mostly in a 2035 target date fund. He has done everything the normal way. He got the match, increased contributions when HR reminded him, ignored the account most of the year, and told himself retirement planning was handled because the plan was automatic. The second person is named Sandra. She also has about $430,000. Same age, similar income, same employer match, similar market exposure. But Sandra looked under the hood. She knows her pre-tax balance, Roth balance, stock exposure, bond exposure, fees, catch-up rules, retirement year, and what she would do if the market dropped 25% before retirement. On paper, David and Sandra look almost identical. In real life, they are not even playing the same game. David owns a balance. Sandra owns a plan. And 2026 is dangerous because balances can look strong right before plans break. The first danger is the Roth catch-up trap. Starting in 2026, many higher-earning workers age 50 and older can no longer make catch-up contributions the old pre-tax way. If their wages are above the threshold from the prior year, those catch-up dollars have to go in as Roth. That sounds technical, but it can change the tax picture for people already trying to squeeze the final dollars into retirement. For years, a 55-year-old high earner could say, "I am behind, so I will make catch-up contributions and reduce taxable income." In 2026, that strategy changes for many people. The contribution may still be available, but the tax treatment may be different. Roth can be excellent, but Roth is not automatically better in every situation, and that is the point. The danger is not Roth. The danger is surprise. If David expected an upfront tax deduction and did not adjust withholding or cash flow, he may discover that his same plan as last year produced a different result. And this is where people make the first expensive mistake. They do not redesign the plan. They get annoyed. They reduce the catch-up. They tell themselves they will make it up later. But at 55, later is expensive. At 30, a missed year can be repaired by time. At 55, a missed year has to be repaired by money. That is how a rule change turns into a retirement gap. Not because Roth is bad, but because confusion creates hesitation, and hesitation near retirement is expensive. The second danger is the tax concentration trap. Most people are obsessed with market returns, but the biggest risk in their 401k may not be the market. It may be the IRS. If nearly all of your retirement money is in a traditional pre-tax 401k, you do not fully own the number on the screen. You own a partnership with the government. If your account says $900,000, that does not mean you have $900,000 of spendable money. Every dollar you withdraw later may be taxed as ordinary income. That can affect your tax bracket, Medicare premiums, Social Security taxation, required minimum distributions, and your flexibility when life forces you to pull money at the wrong time. The traditional 401k gives you a beautiful trade. Save taxes now, pay taxes later. But without tax diversification, later eventually arrives like a locked door. And 2026 is dangerous because more people now have larger pre-tax balances, higher living costs, and less time to redesign the tax structure before retirement. The old advice was simple. Max the 401k, buy index funds, ignore the noise. That advice helped millions of people. But simple advice becomes incomplete when the account gets large. A 1% mistake on $20,000 is $200. A 1% mistake on $900,000 is $9,000 every year. A bad tax decision on $1 million pre-tax account can follow you for decades. That is why the physics of the 401k changes. Below a certain level, your main problem is accumulation. Above a certain level, your main problem becomes control. Control over taxes, control over timing, control over withdrawals, control over behavior. David thinks his job is to get the biggest balance possible. Sandra understands that the goal is not the biggest number. The goal is the most usable retirement income after taxes, fees, inflation, and mistakes. The third danger is market concentration, disguised as diversification. A lot of people believe they are diversified because they own a broad market fund. And compared to owning 3 random stocks, yes, they are. But broad market exposure does not always mean what people think it means. The biggest companies now carry enormous weight in the major indexes. That means someone can own an S&P 500 fund, a large cap growth fund, a total market fund, and a target date fund, then proudly say, I have 4 different funds, while unknowingly owning many of the same top companies over and over again. This is not automatically bad. Great companies can remain great. The danger is that people do not understand how much of their retirement depends on the same narrow group of winners continuing to win. It feels like owning the whole American economy, but the steering wheel may be controlled by a smaller group than you imagine. If those companies keep delivering, your 401k looks brilliant. If leadership rotates or valuations compress, your boring diversified account may behave like a concentrated growth portfolio. This matters most for people within 10 years of retirement. A 28-year-old can survive a lost decade with contributions, time, and career growth. A 58-year-old does not have the same repair tools. If your portfolio takes a major hit right before retirement, the math changes. That is sequence of returns risk. Average returns do not retire you. Spendable dollars retire you. If you lose money early while withdrawing, you are selling more shares when prices are down, leaving fewer shares to recover later. This is why 2026 is dangerous, even if nobody knows whether a crash is coming. Many people are carrying 30-year-old risk assumptions into a 10-year retirement window. They still think like accumulators when they need to start thinking like transition planners. The fourth danger is the target date illusion. Target date funds are not evil. In fact, they have helped millions of people avoid terrible decisions. They rebalance automatically, give workers age-based portfolios, and prevent the classic mistake of sitting in cash for decades because investing feels scary. But target date funds also create a dangerous psychological shortcut. People see a date in the name and assume the fund knows their life. It does not. A 2035 fund does not know whether you have a pension, whether your mortgage is paid off, whether your spouse has assets, whether you will retire at 62 or 70, or whether you need cash for the first 3 years of retirement. It knows one thing: the date printed on the label. Useful, but not personal. David owns a target date fund and believes he has outsourced retirement planning. Sandra may also own one, but she treats it as a tool, not a brain. She checks the stock percentage, bond percentage, fees, glide path, and whether the fund matches her actual withdrawal date, not just her birthday. This difference sounds small until the market tests both of them. When David's fund drops, he is shocked because he thought target date meant safe. When Sandra's fund drops, she may not be happy, but she is not surprised. And in investing, surprise is expensive. Surprise causes selling. Surprise causes contribution cuts. Surprise causes people to move to cash after the damage and wait too long to get back in. The fifth danger is the hardship withdrawal and loan trap. A 401k is supposed to be long-term money, but life does not always respect that. Rising living costs, debt payments, medical bills, job changes, and family emergencies push people into retirement accounts. A loan feels harmless because you're borrowing from yourself. A hardship withdrawal feels necessary because the emergency is real, but the account does not care why the money left. Once it leaves, it stops compounding. And the cruelest part is that withdrawals often happen when the household is already stressed, markets may be down, and future contributions may be reduced. This is how retirement damage hides. Nobody wakes up and says, "Today I will sabotage my future." They say, "I just need to get through this month." 1 month becomes one withdrawal. One withdrawal becomes a contribution pause. A contribution pause becomes a missed match. This is why an emergency fund is not separate from retirement planning. It is the wall around the retirement account. Without that wall, your 401k becomes the emergency fund, and when your retirement account becomes your emergency fund, your future self becomes the lender of last resort. The sixth danger is fees that looked small when the balance was small. A fee does not have to be large to be destructive. It only has to be permanent. 0.5%, 1%, 1.25%. These numbers sound tiny because we hear them as percentages, not dollars. But on a $600,000 retirement account, a 1% drag is $6,000 per year before you buy groceries, pay taxes, or take any market risk. Over 10 years, that is not just $60,000. It is the lost growth on the $60,000. This is not an argument that all advice is bad. Good advice can be worth its cost when it prevents panic, bad tax timing, or concentrated risk. But expensive advice that only puts you into generic funds and sends quarterly PDFs is not planning. It is a subscription to comfort. In 2026, people need to know what they are paying, who is getting paid, and whether the advice is solving the problems that actually matter: taxes, income, risk, Social Security, Medicare, Roth strategy, withdrawal sequencing, and behavioral discipline. If the only thing you get for a fee is someone telling you to stay the course, you need to know whether you're paying first-class airfare for a bus ticket. The seventh danger is political and tax uncertainty. Nobody knows exactly what Congress will do years from now. Nobody knows future tax brackets with certainty. Nobody knows what Medicare premiums or Social Security rules will become. But uncertainty itself is a planning variable. The mistake is pretending certainty exists. A person with all pre-tax retirement money is making a bet. A person with all Roth money is also making a bet. A person with tax diversification is admitting they do not know the future and building flexibility anyway. That flexibility is the real asset. It lets you choose income sources in a high-tax year, manage taxable income before Medicare, do Roth conversions strategically, and avoid selling the wrong asset in the wrong market. It gives you options. And options are what retirement planning is really about. Not predictions. Options. This is why 2026 should be treated as an audit year. Not a panic year. Not a market timing year. An audit year. You do not need to predict the next crash. You need to identify the places where your 401k can hurt you even if the market does fine. Start with 5 questions. First, how much of your retirement money is pre-tax versus Roth versus taxable? Second, what percentage of your 401k is really in stocks and how much overlaps across funds? Third, what are you paying in fund expenses, managed account fees, advisory fees, and plan costs? Fourth, if you're over 50, do the 2026 catch-up rules change your tax picture? Fifth, if the market dropped 25% this year, would your retirement date, contribution behavior, or withdrawal plan change? That last question matters most because risk is not a number on a statement. Risk is what forces you to change behavior at the wrong time. If a 25% decline would make you sell, your portfolio is too aggressive no matter what the spreadsheet says. If a 25% decline would not affect your plan because you have cash reserves, bond exposure, income strategy, and a realistic timeline, then volatility becomes uncomfortable but not fatal. That is the goal. Not to avoid discomfort, to avoid fatal mistakes. David never asks these questions because his balance has been going up for years, and rising balances are dangerous because they make people feel smarter than they are. A bull market hides weak plans. Strong returns cover bad fees. Employer matches cover low savings rates. Market gains cover tax concentration. Then one difficult year exposes everything at once. Sandra asks the questions while things still look fine. That is the entire difference. Planning is not what you do after the account breaks. Planning is what prevents a normal downturn from becoming a personal crisis. Now let me be clear. This is not a recommendation to cash out your 401k. It is not a recommendation to stop contributing. For many workers, the 401k match is still one of the best deals available. Tax-advantaged savings still matter. Long-term investing still works for disciplined people. The point is not to abandon the 401k. The point is to stop treating it like a magic box. A 401k is a powerful tool, but a tool can build a house or cut off your thumb depending on how you use it. In 2026, the people who get hurt will not only be reckless investors. Some of them will be responsible savers who followed outdated rules too long. They contributed. They stayed invested. They ignored noise. But they never updated the plan, checked the tax structure, looked through the target date fund, questioned the fee, built emergency reserves, or created a withdrawal strategy. They thought retirement planning meant accumulation, when accumulation was only phase 1. Phase 2 is protection. Phase 3 is distribution. Phase 4 is tax control. If you're under 40, the danger of 2026 is not that your account might fall. The danger is that you might use volatility as an excuse to stop buying assets when your greatest advantage is time. Keep the match. Increase the savings rate when possible. Watch fees. Build the emergency fund so the 401k stays untouched. If you're 40 to 55, the danger is drifting. You're no longer early, but you're not at the finish line. This is where tax diversification, contribution increases, account consolidation, and risk review matter. If you're 55 to 65, the danger is sequence risk and tax rigidity. You need to know what money you would spend first, what money you would leave invested, what money you might convert, and how you would survive if the first retirement years were ugly. If you're already retired, the danger is assuming the 401k balance is the same as retirement security. Withdrawal rate, taxes, Medicare, inflation protection, and cash reserves matter as much as investment return. That is the real message of 2026. The 401k is entering a year where the defaults may not be enough. Default savings, default funds, default tax treatment, default advice. Defaults are designed for average people in average conditions, but your retirement is not average to you. It is the house payment, the medical bill, the grocery budget, the dignity of not asking your children for money, and the ability to sleep when markets fall. That cannot be left to a menu HR selected years ago. David waits for his statement to tell him whether he is okay. Sandra builds a system that tells her what to do before the statement arrives. That is why Sandra's account does not need a perfect year. It needs a survivable year. And survivability is the word most investors forget when markets are good. Everyone wants maximum return until maximum return comes with maximum regret. Everyone wants simplicity until simplicity hides concentration. Everyone wants automation until automation drives them into a wall they never saw coming. So no, 2026 does not have to destroy your 401k, but it can expose every weak assumption inside it. It can expose whether your diversification is real or just repeated exposure with different fund names. It can expose whether your tax strategy is flexible or trapped. It can expose whether your emergency fund protects your retirement or your retirement account is secretly protecting your emergency fund. It can expose whether your advisor is adding planning value or collecting a toll. It can expose whether your target date fund matches your life or only your birth year. It can expose whether you are an investor with a plan or just an employee with a password. And that is why this year matters. Not because the calendar has magical power, not because 2026 knows your retirement date, but because there are years when small rule changes, market structure, household stress, tax uncertainty, and investor complacency stack on top of each other. When that happens, the people who survive are not market predictors. They are the people who removed the obvious weaknesses before the market tested them. Do the audit. Check the tax mix. Check the fees. Check the overlap. Check the catch-up rules. Check the emergency fund. Check the withdrawal plan. Because the most dangerous thing in your 401k is not 2026. It is an old plan pretending it is still current. And if you fix that before the year fixes it for you, 2026 does not have to be the year your retirement gets weaker. It can be the year your retirement finally becomes real.